Hello, everyone.
Hello, everyone. We hope you had a good weekend and welcome back to another content video. Today we're going to be covering OBs and their variations. So obviously this is how we enter the market following the BFI orders. Cool, so we're going to get straight into it. What is an OB? So it's the process of BFI entering large orders into the market. And then what is that process? So first thing they have to do is create a sideways range. And they do this in order to stack their positions discreetly. So obviously if they just sold, it would just drop. If they just bought, it would just fly up. So what they do is they create a sideways range and they create liquidity on both sides. And their intention is to transact their orders, take the liquidity from the high, take the liquidity from the low. So essentially that's that buy to sell that we see, or obviously if it was the other side, it's the sell to buy, and that's their footprint. Essentially it's that buy before the sell, and that sell is that initiation that causes a breaker structure low, which obviously we know is that strong high in the market. And that creates that initiation of the lower prices. And then what they do at the bottom.
So then when we're looking at this sideways range and we're trying to understand what's happening, right? It's BFI transacting orders at volume. So there's hundreds and hundreds and hundreds of orders that they're activating, they're initiating inside this range before the future move. They know what's going to happen. They're initiating all their orders, and this liquidity that they're creating is that first part of the process of where we see that OB being created. So it's just important to understand what's happening behind the candles, and this is the representation of what we're seeing when we're seeing that range, that buy to sell price delivery, creating that OB, as Burton said.
Exactly. And then basically so they've created this price range. So obviously we've got sideways ranges where they're stacking their orders. We've got price range, which is between this high and this low. And obviously the idea is to take this low, this becomes a weak low eventually, but in order to mitigate out of their orders, they need to buy back up. So essentially then we see that sell to buy, mitigation to mitigation, in order to create higher prices and to create cause for lower prices. So obviously underneath all these lows becomes liquidity. We see that as stack liquidity. And essentially they're sell to buy in order to push up, mitigate out of this position, and then obviously continue lower prices, which is that whole buy to sell price delivery. So they're always transacting orders, whether that's at higher prices or lower prices, essentially.
And this is they're essentially creating that initiation in price. And what we're seeing here when we're seeing this OB and we're seeing that aggressive or semi-aggressive move away, this is how we can identify when the BFIs are initiating or are inside the market. For us, this is what we understand as an ideal price delivery. This allows us to start understanding and following their intentions, right, as price starts to get delivered. And again, we all know what we're looking for. It's just about gaining that understanding what's happening behind the scenes so you can follow it clearly. So as Burton said, that low is created to hold the range and create that cause to support lower prices in the future. But before that happens, we move up to mitigate out of the losses. And now I think a good question, Burton, that a lot of people answer around where we look at within
where we look to enter.
Yeah, where we're looking at. I think the first thing to note is the BFIs are always activating or initiating their orders inside the range. It's never outside. So when we're trying to understand where a mitigation is going to happen, we want to understand that it needs to be a true mitigation is going to happen inside the range. Even though we can see them happen at the open, we understand that that's creating something for the future. But a full mitigation typically is going to happen inside the range, not outside. But where do we enter, Burton?
Cool. So obviously this is a question that comes up quite a lot for us. Do you enter at the open or the 50%? And to be honest, we need to be aware of both because we never know whether it's going to be the open or the 50%. 50% is obviously the best entry because all the orders are stacked within that whole buy to sell. So let me draw that out. All the orders are stacked within that buy to sell. So 50% is the best entry because obviously we can get the best stop. And obviously optimal is all the orders are inside. But obviously we need to be aware of the open because we never know, that could just mitigate here and then just drops. So these are the two areas that we're looking at: 50% and open. Obviously, we never know. For us, it's like we want to use 50% if the stop's over 2 pips. Normally, obviously, we can enter at the open if we see that reaction at the open, but the ideal entry for us is going to be 50% if the stop is under 2 pips. Obviously, if we're trying to enter at the 50% and the stop is 6, 7, 8 pips, and we're probably not going to take the trade. And as well with the open, if the stop is 4, 5, 6 pips, then we're going to look to enter at the 50. But yeah, always be aware of both. Sorry, go on.
But I was going to say, yeah, that that in itself is guiding us on our entries. So we're not just jumping in and saying, I take 50% or I take open. It's, first of all, we're looking at a lower time frame. So majority of the time, our stops are going to be relatively pretty small, right? But this is where we want to, exactly, it's determined by our RR essentially and where our stops. So for me personally, I like to just think about first, where's the best and safest stop placement? And then I kind of work backwards from there. If I'm able to have my entry further to the open, then I'm happy to do that, right? But a lot of the time I found that, it's a variation between the open and the 50% typically. And like I said, it comes with experience and it comes with understanding, because again, at certain times, price delivery here might be able to give you a clue on where price might be coming back to mitigate. So again, we can kind of refine our areas even more. But again, it definitely something that comes with experience. I think it's just about being more open to the idea around the mitigation rather than forcing yourself to think open or 50, right? Just pay more attention to understanding that price is likely to mitigate and turn in that area. And then it's just about catching the trade from here or obviously catching it afterwards.
So just this example on the right here, this is an example of an aggressive move away. We see that very strong move away. We could say it's something like this or something like this, very strong moves away. Let's move that. Whereas this is more of a semi-aggressive move away where we see, sometimes like this, and then we see a push. And basically what that's doing is just creating liquidity for that mitigation, essentially, that semi-aggressive move away. And then obviously we see liquidity being created within that price range, high and low, for obviously future to be run, to continue them lower prices. And obviously then that becomes a weak low. So basically between that high and that low, now once you've had that initiation of lower prices, whether that's aggressive or semi-aggressive, now the idea is to create more liquidity within that range and to take all the liquidity from the range. So take the liquidity from the high and the low, which obviously that's what we see here, that liquidity taken. And then the next idea is to aim for that swing low. And obviously that's where we see all these lows and the weak low run as well.
Exactly. And that is obviously how we're looking at that continuation of the mitigation, right? Of the intention created. So mitigation and continuation in lower prices. This is what is probably the most easiest thing to think, but obviously depending on what the picture is in your higher timeframes. But this is where we're looking at that continuation and lower prices.
Yeah, so we wanted to say as well, what is mitigation? So essentially why the banks buy to sell is in order to transact their orders into the market. So they're going to have one position that's in a loss in order the one that bought before the sell, and obviously they've got one in profit. So now they need to mitigate out of their loss orders at break even before they continue price lower, and that's essentially what the mitigation is, keeping it as simple as possible.
Definitely. And it's literally the process of how OB is created.
Exactly.
Anything else? Yeah, so I think the things just to remember here are, don't just listen to us, go onto your charts and look for these things yourself. We're going to show you some examples shortly, but just remembering that we can talk about the theory and the idea behind it, but you want to train your eyes to see this price delivery on your charts. So, things to remember, this picture in front of us is allowing us to understand the intentions of BFI. So are they trying to create higher prices or are they trying to create lower prices? This picture in front of us and the understanding of the OB and the process of an OB created is is allowing us to follow the intentions and make sure that relatively majority of the time we're on the right side. The next one is OBs create higher time frame highs and lows. So where we're seeing this price delivery, you'll notice that at certain points, this becomes a higher time frame high, right? So something you might see on an hour. And then the last, sorry,
I was going to say as well, this is how we're able to only look at the 1 minute, because if we can see this on a higher time frame, this is a whole push up. So this might be like 4, 5, 6 buying candles before an initiation, and this might be a 2, 3, 4 candles sell to buy. Now we know that we're in a price range. So this is how we're able to only look at, let's say, for example, last Friday, only look at the 1 minute in order to trade, because we know that we're in low prices of this price range high to low. So now we're looking for buys, and now we see this whole buy to sell. So we know that price needs to come back to mitigate out of this order here, and that's how we're able to buy and catch buys on the way up.
Yeah. And this literally is why we say don't have a bias, because if you're marrying your trades and you're not understanding, what the price and the intentions of the price is, then you will be holding trades that are going to get run against you, right? So we don't marry. We understand that some trades are going to be ones we hold, and some trades are going to be ones we don't want to hold for too long. And again, it's an understanding that comes from experience. So next, we're going to talk about where to look for an OB. So you might realize now that we focus a lot on ranges, and now I guess you understand, right? Because we understand OBs are happening from a range. So first of all, this is the most easiest place you want to look at to locate an OB. And as we know, the initiation of lower prices will typically start inside the range. Right? So this is again where we're looking for. We're looking for an OB that's inside the range. So for example, if we're looking at this example we have in front of us, right, that initiation of lower prices, right, might have happened here. So this is where we can expect price to return when it comes back into this range. And this is where we're looking at our higher timeframes and lower timeframes, but we're able on a 1 minute to see all of that price delivery. And this is why we want to focus on ranges.
Cool. So the next part of that, so this is a different sort of price delivery, but still following the same logic. This is mitigation to mitigation, which you'll see a lot of my markups. So essentially, once we've initiated out of a range, we've got that whole buy to sell. Draw that in. So we've got that whole buy to sell, and then this whole buy to sell then becomes that mitigation. So it mitigates out of this order, but creates a new buy to sell, and then obviously we get that whole new buy to sell again. So mitigation here, create a new order, buy to sell. Mitigation here, create a new order, buy to sell, and then we might get that aggressive move away, which is that whole move down, initiation of that lower prices. And then this is the last known mitigation, which means this is where all the money is. So obviously then when we see that mitigation, that's when we see that continuation of lower prices. And all of this is just a stacking of orders, but in like a sideways way, if that makes sense. But it's just stacking of orders to then push price lower, mitigate and continue lower prices. It's just another variation of this, but mitigation to mitigation. So even just on this chart here, I can see a range, sideways delivery, a sell to buy, it's been mitigated here. And then within this candle, so obviously this will be second time frame, let me clear this up. So we've got range, initiation of higher prices. We look back in the range to see the OB, which is that sell to buy, mitigates here. Then on lower time frame, this is that sell to buy, mitigates here, sell to buy, mitigates within this candle here, mitigates here, mitigates here. So as you see, BFIs are always transacting. The most important thing is to understand this price delivery, and obviously this one that just went that was here, because then you can see mitigation to mitigation happening as price is moving higher. So obviously that means that you can catch the continuations, and you're obviously seeing that whole price delivery, which you're able to see on higher time frames, and you're able to get involved when it's super clean, like this, for example, range, initiation, lower prices, all these lows become liquidity. obviously this is a seconds time frame. This is what this would look like on a seconds time frame, mitigate and continuation of lower prices. But then even we see after the mitigation, we see another buy to sell, mitigation, continuation of lower prices. So it's always happening. It's just about training your eyes to understand to mitigation, and then full price deliveries, which is essentially both of these.
Essentially, you're following this mitigation to mitigation, you're following that intention of lower prices. And it's how we're able to continue, well, how we found that we can continue to enter as prices moving away. And we're not necessarily having to wait, you know, to tomorrow for it to pull back up to, you know, a higher time frame.
Yeah, a POI.
Yeah.
This is why people are so focused on POI, because they see this price delivery but don't really understand that even on the way down, BFIs are still transacting sells, and even on the way back up, BFIs are still transacting buys. But it's the whole price delivery that's important. This is obviously why we go over price delivery so much as well. But
it's known what phase you're in.
And
then when you're, just quickly to say, when you're looking at a range, right, that has been left unmitigated, right, this is when we understand that there's been no mitigation of that range, so we can expect a mitigation of that range.
That's essentially a future point of interest. So again, if price comes up here very slow, creates a lot of liquidity underneath here, this is a potential, as we say, a reaction or reversal point. Again, this is obviously following, if higher time frame is bearish, this is a potential reversal point, obviously, where we're going to see a momentum shift from bullish, which is that whole move up here, that bullish move up, to bearish to continue lower prices, essentially. And that's why we're looking at that whole buy to sell delivery. This then becomes an unmitigated range or unmitigated OB, still the same thing. And then obviously that's where we get involved in lower prices, which is essentially just this. It's literally just this, it's just a different variation. So this could move, sorry, let me clear this. So this could move down, move back up, move back down, move back up, move back down. It could do anything at once, create more liquidity before obviously it mitigates and continues lower prices. Just as an example here, we don't know.
Yeah, exactly. And it's more of, I mean, that's just looking at what we're seeing here, you know, consider the higher time frame you're looking at as well. And that's something to say, which is, you know, if you're seeing this here, you know, understand what's happening left, understand what this range is, right? Where this has come from, and where, you know, is this around 50% of this higher time frame range, and start thinking about your time frames and how they can correlate to each other. Again, it's nothing you need to know straight away. It's like you need to know what every single time frame is doing, and you know, you need to know what range you're within and XYZ. It's something that will come over time. But again, train your eyes and learn to see these things. You know, it's as simple as, you know, when we first started, we used to see these things and draw boxes on every single one, and to understand how price is going to be respected. And we found out some turn to liquidity and cause to create higher prices, and some actually are the full mitigations and the continuations to lower prices. And that's where we understood that we was identifying those points of those mitigations and following this intention, right, of lower prices that was brought in. And this is what started to build this narrative and this logic of what we was witnessing in price, right? And then what we get into next, actually, no, just to quickly say, one thing to note as well on when you're looking at ranges is when you're seeing a high on a higher time frame, and it's, you know, at that high there's been a range, there's been an initiation, but that high has been left unmitigated and price continues to go up. So for example, just like this one, right? Let's say price is moved away and is left unmitigated. This type of price delivery is what creates a higher time frame OB. When you look at this type of price delivery we're getting, right, this is where we want to start understanding, right, has this 1 minute lower time frame price delivery left a higher time frame point of interest? That means that this point is visible as a point of interest on a 5 minute, maybe a 15 minute, maybe an hour, and so on. Doesn't matter. It could be a 30 minute, right? We're just talking about a higher time frame. Yes, and then that obviously brings us up onto now, which is when we're understanding OBs and what we look for, we also need to remember that we're looking at a representation of price, and that representation is going to look different So now we can get into our types of OBs.
So cool. So what are the types of OBs that we look for? So just before we go into this, all OBs are a representation of the same logic. They were looking at buys to sell or sells to buys. So you have to think about how OBs are created on the M1 and what they might look like on the higher time frames, and what higher time frame OBs look like on the lower time frames. So OBs that we look out for, that we know of, are full-bodied OBs, and obviously we're going to go through examples of this next. Full-bodied OBs, FU wicks, which are lower time frame OBs, OBIM, which is OBs that create imbalance as well. So that means that banks and the algorithms, the central banking algorithm, are both working together. And then a last buy within a range before an initiation of lower prices. So last buy within a range before initiation of lower prices. The last sell within a range before an initiation of higher prices. Then any candle that takes liquidity before initiating higher or lower prices, or any candle that mitigates a previous OB. And then obviously the last one is inside bars followed by an initiation of higher or lower prices, obviously depending on which one we're looking at.
And again, it's we're looking at the same thing here, even though there's, you know, all of these things we're listing. What we're talking about is the same thing, but the representation of that looks different depending on, you know, the duration of time it happens over. So yeah, don't be overwhelmed. Just pay attention and understand that we're looking at the same thing. It's just the variations of it.
Cool. So now we're going to go on to the chart and show you some examples of exactly what we've just said. So cool, let's get into it. Cool. So the first one I wanted to go over was the mitigation to mitigation. Essentially, this is that whole sell to buy, which we just went over in the price delivery. But this is following mitigation to mitigation. So sell to buy mitigates here. Then we see that whole sell to buy again. So again, another footprint, which means this is the OB now. It's mitigated a previous OB, reacted, causing a break of structure high. So obviously that's mitigation to mitigation. So we're following the mitigations now, following the mitigation here. This is a whole sell to buy move. So again, that's another mitigation there. So again, let me just draw that in. So mitigation to mitigation, whole sell to buy move, which is obviously mitigated here at 50%. So then that becomes that sell to buy, mitigates here again, mitigates open and continues higher. So this is the last known mitigation essentially. And then now this sell to buy mitigates this previous OB here and causes a reaction to the upside. So just something to note here, obviously we're looking at whole sell to buys here. This is essentially a higher time from OB, sell to buy, sell to buy, sell to buy, and this is essentially following the money. And obviously this is creating higher lows in the market, which is obviously what we're following. That's obviously BFI is creating structure in the market as well, but this is a full-bodied OB, which is very important on EU. This is a whole sell to buy, which obviously we can see on this time frame, but full-bodied OBs on EU are almost guaranteed a reaction. So they're ones that we obviously need to focus on. And obviously we see that here. I think this is NFP as well. So reacted to 50% of this full-bodied OB and then continued higher. So these are ones that I love playing. These are ones that I'll just literally leave an order on because I know that they're very likely to see a reaction. Pretty much always seen a reaction on a full-bodied OB.
Especially taking in the full picture, right, of what's happening down here, what's been happening, and then what this full-bodied OB creates, right? It's not that we're just looking for this. We're talking about it from a full picture perspective.
And essentially, that's that whole price delivery, which obviously we always talk about, being that range, initiation of higher prices. Where's the footprint? That's sell to buy. So that becomes our footprint that we're looking at here. And obviously, then we're looking within the range at that last sell to buy footprint. So let me clear that up. That will essentially be that sell to buy footprint within the within the sideways range. And then obviously that creates that price range between the high and the low. And obviously now that comes back down to mitigate the previous OB, which obviously we've followed the money, which is following the mitigations all the way up until this OB. So we know that this is the last point where they sold to buy. So they need to mitigate out of these orders before price can then continue higher. And obviously that's what we see there. So this is just a variation of this. It's exactly the same. It's a variation of all of these It's just represented in a different way.
Mm-hmm.
And obviously we see this as full-bodied OB, which are very, very good on EU for seeing reactions. Cool. So our second example, we want to look at the last buy within a range before an initiation of lower prices. So again, this can even we can even go and follow the mitigations here. Buy takes out liquidity, initiates lower prices, mitigates, and this whole buy to sell becomes a mitigation. And this is a good example. This is that semi-aggressive move away that we see, and then obviously mitigate out of those orders and continue lower prices. But obviously, in this example, we're just looking at this sideways range. So even if you didn't see this, you could just still identify that this is a sideways range. And then obviously after we've seen that initiation of lower prices, now we're looking back into the range to see the last buy, the last move up before that sell, and that creates that BFI footprint that we were just talking about in the price delivery, range, initiation, mitigation, continuation. And obviously then we mitigate out of the open and continue lower prices. So again, this is just another example, and obviously this has created future liquidity there as well, being those equal highs. But this is just another example of the same logic, the buy to sell. So it's all about the footprint. This is something we look for all the time, that buy to sell footprint, buy to sell footprint, buy to sell footprint. We're always looking at the buy to sell footprint. And obviously, again, this is just another example of looking at a buy within a range before an initiation of lower prices. So this is the next example. This is example 3. So now we're looking at, again, mitigation to mitigation in a selling environment here. So this candle here takes out the liquidity from this high and initiates lower prices. And again, we've got that whole buy to sell, mitigates here, mitigates open, and then that creates, sorry, let's move this, and that creates a whole buy to sell again. So another footprint. So again, this is following the mitigation, buy to sell, buy to sell, buy to sell. And the last known mitigation is this candle here, which again, this is our trade from earlier in the week. And again, that creates that footprint, that whole buy to sell, no mitigation, then create liquidity within the range. So obviously this is the price range high to low. Obviously we've created liquidity down here after the mitigation to continue. And it's taken all the liquidity, let's move this, taken all the liquidity out of this range. So all the liquidity from the highs, mitigated out of the orders here from that buy to sell footprint. And then now it's going to take all the liquidity from the lows. So obviously we have liquidity down here, liquidity under here and under here. And obviously that creates some more liquidity there. But again, it's just another example of following the money, following the mitigations. This is the last known mitigation, which means this, anywhere within this whole up move before the down, the buy to sell, anywhere within this zone is our opportunity for entry.
And then just again, to take in the full picture, that we're not, even though we're paying attention to these mitigations and the mitigation away from this strong high, again, taking your timeframes, go back and look what this actually is on a higher time frame, what these two highs are, right? What this high here is, and what that representation is of that. Right? This is how we're starting to understand how the higher time frame creates these strong highs and how price is initiating and moving away from it. Exactly. So yeah, tip here is make sure you're using your time frames again to recognize that and train your eyes of what you're seeing.
Essentially, if you're able to see this on a lower time frame, this delivery here, this creates narrative for higher time frame, because the time frames are going to move exactly the same. They move in the same way. The only difference is obviously the time. So if you can see this whole buy to sell delivery on a higher time frame, and you know that you're at low prices here, but you've seen BFIs sell to buy, you know that you can enter a buy position to buy back up into this mitigation essentially. And that's how that's literally how we trade. And obviously that's the example that we showed you previous as well.
It literally comes into talking about, you know, understanding, do you believe you can be flawless? Do you believe that you can take flawless entries? Well, if you know that price has intentions for higher prices at this point or at this point, where do you start to get in? And how likely are you going to pick one, the right direction, and two, the right places to get in? Over time, you will. And, you know, this is what leads to flawless entries, right? A good understanding of intention and what we're seeing across, you know, higher and lower timeframes.
Cool. On to the next example. Cool. So now on to the next example. Again, we're just following the money. So we've seen that move down. We've seen this inside bar here, initiation of lower prices, mitigation and continue lower. Essentially, this has just created liquidity here. But this whole, let's move this. So this whole buy to sell, money's now in this candle, buy to sell, mitigate here, and continuation of lower prices. But essentially, we can use the whole footprint. So this whole buy to sell anywhere in this zone. Again, this high is a strong high, so it's protected. But now we look back into the that range. Essentially, this is the whole sideways range, initiation, mitigation, again, continuation. But obviously, momentum shifted here, so this just became liquidity for higher prices. But essentially, what we want to do is look back within the range at that last buy to sell, and here we can see the inside bar. So it's inside both of these candles.
Zoom in a little bit as well.
This is a lower time frame range. Initiation, mitigation, continuation, and obviously we see that reaction here. Momentum's already shifted, so this just becomes reaction, no follow through to create liquidity for higher prices. But again, it's the same thing. We're just here's an inside bar, initiation, mitigation, continuation, which again, lower time frame looks like this. And again, we see exactly the same thing here: range, initiation, mitigation, continuation. It's exactly the same thing happening. Sorry, redraw that. Exactly the same thing happening over again. We're literally just looking at that last inside bar before the initiation. So that's the next part. It's that inside bar, which is a lower time frame range before the initiation. So that's another way to identify lower time frame OBs. And obviously we can see this on the higher time frame as well. This is something that we look for. So if we've got an inside bar, let's say we've got this move here, this is an inside bar. And then we've got an initiation of higher prices. We know that this is a lower time frame range, so this becomes our zone essentially. So when price comes back into this, mitigate and continue higher prices. That's exactly the same what's happening here. Inside bar, initiation of lower prices, back into mitigate that range, which obviously we know is a lower time frame OB, and then obviously continue. And so it's just exactly, it's another variation of the same logic of range, initiation, mitigation, continuation. But yeah, it's just another way to identify OBs on a lower time frame. And obviously we can use this on higher time frames. So we could, let's say, for example, see this on the 15-minute, like a inside bar, initiation. We're at high prices now, so we want to look to sell down into this unmitigated range to then continue higher. So obviously that's how we're then able to sell up here. And then back, we have our narrative essentially. We're selling back into that inside bar. Sorry, it's not a very good example of inside bar, but inside bar here to obviously then continue higher prices. But there. Cool. So our next example is an FU wick, which is a lower time frame OB. So essentially it's this candle here. It's a very strong move down followed by a very strong move back up, which creates a large wick, which is essentially just a lower time frame order block. So we're taking the same logic again, sell to buy, and obviously that's where we see that wick. That push down, aggressive push back up, obviously becomes that lower time frame OB. So this one again here took out all the liquidity from the lower of the range for initiating higher prices, created future liquidity, and then obviously mitigated and continued higher prices here. So it's keeping it very, very simple. This is just the lower time frame OB, and we're just using the same ideology, that sell to buy, mitigate and continue. So exactly the same. Just another variation of the same thing. So here we see it again, that sell to buy, mitigate out 50%, continue higher prices. So it's again just another variation of the same thing. These are some of my favorite ones. The FU wick and the full bodied OB are both almost guaranteed to see a reaction every time. So these are my top two ones that I look out for within price delivery. And again, we're just in that sideways range. We've taken the liquidity from the low, taken the liquidity from the higher the range, created future liquidity. Again, all these become weak highs because they're all going to be taken. And then it's again that same range, initiation, mitigation, continuation of higher prices. We look back within the range to see that that's the FU wick, taking out all the liquidity for initiating higher prices. And it's literally as simple as that.
It's nice aggression in there as well after that. Right, clear footprints coming into the market.
And this essentially, this push down here, this within this wick here, some might say that that is a FU wick, but essentially in this whole price delivery, this is creating liquidity essentially for that mitigation. Just you want to always be looking at the extremes of the price range. So this is the low to the high. Just imagine there's a 50%, and then this is the lower half. Obviously, this is the higher half of the range. So just draw that in again. So this is the lower half of the range. Anywhere within the edges of the range. So the bottom kind of 25% is where you want to be looking. Anywhere underneath 50 is going to be obviously discounted prices. But anywhere, if we was to split that in half, this is the bottom half of the range. This is the absolute cheapest part of this price range that's being created.
And again, understand, look how price is moving and what price is creating. This creates another range, right? And initiates out of it. This is obviously a higher time frame range in here.
Exactly. And even here, even just taking this logic of this understanding, this is all inside price action. So it's inside this price range. Obviously, that's how it's a higher time frame. So this will just be an inside bar on the higher time frame, because all this price action within this high and this low. This is creating an inside bar and initiation. So that's how we're able to see again lower time frame creating the higher time frame. So yeah, just another tip there as well.
Range. This is why we like ranges so much, because essentially everything is happening from a range.
Exactly.
Cool. On to the next one.
It's cool. So this is the next example here. This is where we're looking at higher time frame OBs. So again, we're using that whole sell to buy ideology again, but we're looking here within this range. This is a whole sideways range here, stacking of orders. And obviously we see that whole sell to buy, price delivery. And obviously that's mitigated here, sell to buy, mitigation here, continuation of higher prices. So obviously we've got that full bodied OB, which you guys now can identify within this range, initiation, mitigation, continuation. But this whole sell move before initiation of higher prices then becomes a higher time frame OB. And obviously we see the reaction from the open here, reaction from the open here. Obviously the momentum has shifted to bearish. So this now, this reaction of this open here now becomes to create liquidity for lower prices. And the next one we wanted to show you as well is this whole, on that one, this whole sell to buy out of this range. Obviously we see mitigation here, but it hasn't mitigated out of this sell to buy at the bottom. And that's obviously where that's created that higher time frame point of interest that we talk about, that whole sell to buy delivery, where we get a reaction here to create liquidity for lower prices. So obviously everything is all correlating to each other. The whole sell to buy here was to mitigate here to create more liquidity for lower prices out of this range, initiation, mitigation, continuation of lower prices. And this is obviously how we understand every single move in the market has its reasons. We just obviously have to find that as traders. Exactly.
So when price is pulling back into this, I'm sitting here and asking myself, why was this created? Well, once we get that momentum shift and price starts pulling back, and we get this reaction, right? I'm literally being told as price is delivering what this is made for, right? We can see there's hardly any reaction and no follow through, no swing high taken. So what do we know this becomes? It becomes cause for lower prices, right? This is what sets us apart. This right here is what sets it. No one is talking like we're talking now. And this is, I'm not saying this to showboat or you know, big up my ego. I'm just trying to give you guys the importance of this information, because it's this that allows us to hold our trades, right? It's this that allows us to take the right positions at the right time, right? And it's these finer details and this kind of full picture understanding is the skill that we talk about, that you guys need to, the level that you guys need to hit. Well, the level that you guys should be aiming for, because with the refined skill and a great skill that you'll gain over time is how you start to take these entries consistently, time and time again. Because as you can see, we're following that same narrative of where we want to be taking our positions, right? But we're adding that to the understanding of price delivery over time, which is obviously where we start to talk about our structures, our time frames, our breaker structures, and we're essentially, putting all this information together, and then we're able to execute with high confidence because we understand what we're seeing, right? So just simply said here is, if I got into the short trade, right? If I was in this trade short or have caught any other trades after it, I'll be holding my position at least below this low, right? Because we understand why this has been created. Where, you know, some other, again, you can play that trade long as a hedge, but again, we understand that this move, right, you can play it, but there's, you know, we want to understand and watch price delivery as it's moving away to understand whether this is intentions that is coming to the market for higher prices. Again, it just keeps you, you know, it keeps us one step ahead and understanding. And this is why we're never surprised in what we see, because price has been setting these types of moves up, you know, or are setting these types of moves up all the time.
And that's how we obviously see it as well. So once we understand this is a mitigation here to create liquidity for lower prices, we can also say, well, these BFI orders here, this sell to buy delivery, this whole delivery here was to now create liquidity in order to mitigate out of here. And obviously we see equal lows created here just before that mitigation that happened here. So obviously that intention, now we understand that intention of this price delivery was to create this for future liquidity to mitigate out of these orders here. So obviously that's just us in the moment understanding what's happening in this whole price delivery here.
Exactly. And this is why we say you want to mark up in as much detail as possible, because this is what's going to allow you to start seeing these things. Like, I'm sure now Burton's taken all the boxes off the chart. You know, do your eyes see this? Right? Are your eyes going to these areas? My eyes are. And this is where we say you need to, you know, train your eyes to see these things, and you will over time. And you know, how much time? If you're marking up every day, then your progression is probably going to be pretty quick. So this is why we recommend that you should mark up.
And essentially, this is another thing that we didn't even plan for in this video, but I've just seen. This is essentially that mitigation here. That's a whole sell to buy, mitigate out of 50%. And then what happens at 50%? We see range on a lower time frame, but we can see it here. Initiation, mitigation, continuation of higher prices. Why was that mitigation happen? Obviously to mitigate out of this buy to sell. So as we see, even though, so obviously our example that we had before with the range initiation, and then we get that sell to buy delivery mitigation to initiate higher prices to obviously mitigate out of this, we can see it happening here. So exactly the same thing is happening here over and over and over again. We can literally draw it on this entire move.
Entire chart. Only because we're picking these, you know, only certain ones. These are just the examples that Burton's, you know, picked out to show you, but they're happening all over the chart. All over the chart. So again, right, it's in the detail.
Exactly. And even these ones here, so obviously this is something that I didn't plan to put in, but this is essentially, you might have seen entries like this that have been taken before where we have this range. So because the range is so small here on the M1, it means that instead of just taking a specific candle, we can take this whole range, sell to buy, mitigation, continuation, higher prices, and essentially any time it comes back into this range, you want to be entering. And obviously the cheaper half of the range is the optimal entries, anywhere around 50 in the cheaper half, or your stop could go just underneath the cheaper half. But essentially, if your stop's small enough, under 2 pips, then you can just take the whole range, and it's a whole small range. Again, just following that price delivery. And
these are the small refinements that we're doing for our entries, and these are in the moment refinements, right? We're not sitting here with a trading plan next to us and making sure I'm checking off a list of all these things happening. We're seeing this being printed into the market, and we're reacting from what we're seeing, right? If you have confidence, you're able to do this. This is why you want to grow that confidence.
Exactly. So cool. So on to the next example. Cool. So previous, we talked about unmitigated ranges, how they become higher time frame points of interest. So obviously this is an ideal price delivery where we get that A, B, C, D, which is obviously that sell to buy, mitigation, continuation of higher prices. Here we see range. So obviously we got that sell to buy, we get no C leg, which is obviously that mitigation, which obviously means that this is a higher time frame point of interest. So now we look within this range that's unmitigated to find our point of interest. Where's that last sell before initiation of higher prices? And obviously we see this, it's this candle here, took this liquidity here, sell to buy. So obviously now I'll draw on a box here so we can see where that OB is. Move this down. just to show you, this becomes a future point of interest. So obviously now that's a point of interest that we'd have within the unmitigated range. Now let's see the reaction. Because then in the future, this now becomes a point of interest. And obviously we see that reaction was to create higher prices to mitigate out of this buy to sell delivery. So obviously this whole buy before the sell. So again, mitigation to mitigation is always happening. And then again, that just creates that price range for future prices, take out all the liquidity from the range high, take all the liquidity from the range low. So again, we just see it happening over and over again. And this is that unmitigated range that we always talk about. These are the higher time frame points of interest. So obviously people always want to say we're looking at a higher time, we're looking at point of interest, where's the point of interest? This is how you're identifying it, an unmitigated range. Now we look back in the range, where's that last sell to buy? So obviously that's that BFI footprint that we look for, and that becomes a future point of interest for a reaction point to obviously react here, higher prices to mitigate out of this buy to sell delivery. Again, so again, it's just about understanding where your points of interest are, where your unmitigated ranges are, where your unmitigated OBs are, and how they're going to react to this whole selling price delivery that's happening. And that's literally what's just happening over and over again, as we say. And it's just about identifying that.
Quickly scroll back to the previous previous place. So like this is a great, you know, this was probably our first big aha moment, right? When we was looking at the 1 minute and we started noticing these things, and then we was going up to the higher time frame, we started to notice that this was leaving and creating a higher time frame point of interest, right? And straight away we knew, well, okay, well, of course that's going to happen. We're going to first see that higher time frame point of interest being created on the 1 minute. We're not going to first see it on the hour or the 4 hour. We're going to see it being the start of that creation of that OB being created on the 1 minute. And this is why this is when we said, right, the 1 minute is what we do. This is what we're sticking to. We can essentially read the entire chart just off the 1 minute, knowing that we're understanding and reading through our timeframes of what's happening. What does this mean? We're always asking ourselves why. A lot of people get stuck because they will see this type of price delivery in the 1 minute. Maybe this is a previous point of interest. Maybe they took entries here, and then maybe that next person is waiting for that pullback into this range to take that trade. Well, look, the market does not come back, right? So they're sitting there waiting for this higher time frame point of interest to be hit, right? Just to take a trade that pulls back to create cause and continues lower following that higher time frame intention. But look how we move away here, right? We move away, we see that strong initiation, we see that range, and what do we see happen once again? That initiation away. Can you see what they're creating in the cause, right? So the reaction here from this point of interest that we're looking at was already priced into the market here, right? Well, even before then, obviously way before then probably, but in terms of when we can see it, we can see here and here that this was already planned to happen in the future. And this is why we say that we are, price is creating cause for a future move to happen. This is where we want to put our minds and try and understand. We don't want to predict price. Of course we can. It's very easy because we're just looking at the structure, but we want to be in that mindset and saying, right, this is creating something for the future. What is it creating, right? And if we can start answering that question in the moment, right, with confidence and with accuracy, you see how we start taking these types of trades and building our understanding over time. But yeah, this was a big step for us because we realized that we no longer needed to wait for higher timeframes to pull back into the zone to take a trade, right? We can now start coming down to the 1 minute and play in that intention and that move away, even if we don't get this 1 minute, this 1 minute mitigation down here, right? We can still follow those intentions and still get into the markets when everyone else is waiting around.
Cool. So that's the end of OB and the variations video. So just a quick update. We're planning to do a live call every other week. So now we're going to do a content drop every other week and a live call every other week, obviously, just so we can get more into examples or questions or anything like that you guys have. Obviously, we've done the Instagram live, and obviously we've got to thank Toby for giving us the idea of doing some lives now as well. So thank you, Toby. But But yeah, we're going to drop that every 2 weeks, of content, and then we're going to obviously go live with you guys as well. I think that we obviously think that's going to be very beneficial for you guys.
Just trying to find ways that we can add the most value. Yeah, and we think just getting on and getting a bit more personal with us and with you, and just covering any questions you have in the moment or that we've not kind of covered in a lot, or we can't cover a lot that we can't cover over the over message. We can obviously cover it in a live webinar going over price action, and everyone can learn together. So we think it's going to be a much better opportunity for you guys to have more interaction around those videos on a weekend.
Another thing that we've opened as well is 2-to-1s. So obviously we're only going to be doing a couple of these a week. So if you are interested in doing the 2-to-1s, obviously you're going to be getting both of us on a call. Then message us in the Discord channel. We made a specific channel for 2-to-1s, so just drop your name, let us know that you're interested, and then obviously we can fit a time that works for both of us.
And we're, you know, just remember that when you're jumping on with us, we're really trying to dig into, you know, ways to help you improve. So, you know, take that into consideration and understand, you know, what are you trying to improve on, and come to us with that, and then we can obviously just try and point you in the right direction to what you're having problems with, or just, you know, talk about refinement of entries, or, you know, identification of ranges. But, you know, we essentially just want to kind of open ourselves up to you know, everyone, so they can have that individual conversation with us, because we know, you know, some people need to grow from that place. So yeah, you know, we think it's gonna, you know, offer you guys a lot of value.
Exactly. Cool, that's everything. Thanks for watching again, guys. Let us know your takeaway from today's video, and yeah, let's have another focus week and more continuation of the strength in 2021. So thank you, guys.
Thank you. Speak soon.